Welcome to the February edition of our U.S. Executive Podcast. I'm Greg Dacko, Chief U.S. Economist, and I'm joined today by Lydia Bassour, Senior U.S. Economist. Lydia, the government shutdown delayed a lot of economic data. We're now only getting data for the end of 2018. What are we starting to see in terms of the picture at the end of 2018?
So we're starting to see some downside surprise in economic data at the end of 2018. The biggest downside surprise came from the plunge in retail sales in December. They were down 1.2%, and core retail sales posted a big 1.7% decline. But we find the magnitude of the decline somewhat hard to believe, especially as it matches pullback in spending seen during the Great Recession. The report is also not consistent with other data, such as the Johnson Redbook weekly chain store sales, which pointed to solid holiday sales in December. But more broadly, I think the collapse in spending is just hard to square with the fundamental health of the consumer sector. We have a strong labor market, rising wages, and consumer confidence is bouncing back. We got the Conference Board Consumer Confidence Index this morning, which rebounded by the most since 2015. I think the important takeaway, though, is the fact that the U.S. economy ended 2018 on a soft note and that the momentum continues to gradually cool. This was confirmed by the weak housing starts number this morning and by the disappointing industrial production data released last week. So, Greg, these downside economic surprises have brought back fears of an upcoming recession. Are the odds of a recession this year and in 2020 any higher?
Well, our odds of a recession this year are about 25%, and the odds of a recession in 2020 are about 40%. Now, we want to caution that we have to be very careful and fight against a recession bias because, yes, some of the data is soft, but that's typically what you would expect when the momentum is shifting. Remember, in 2018, we had a year where growth was accelerating. 2019 is going to be a deceleration year, and that has implications for how the data comes out, how confidence comes out, and we have to be very careful to understand that there's a big difference between an economy growing as it is currently at about a 2.5% to 3% pace year over year, and gradually moderating towards 1.5% to 2% versus a recessionary environment. So we caution against that recession bias. One factor that's been highlighted, Lydia, is the fact that corporate credit conditions have tightened quite significantly, especially at the end of last year. Where do we see credit conditions evolving going into the future?
So this could be quite concerning because corporate credit is a key leading indicator for the economy. Part of that concern actually came from the latest bank lending survey from the Federal Reserve, which got a lot of attention. It showed a significant tightening in lending standards of commercial and industrial loans. However, I think there are two things to keep in mind when we look at that survey. First, it was conducted during the December financial market turbulence, so that probably influenced the tone of the responses. And then the second point is the fact that the net percentage of banks tightening standards remained very low at just 2.8%. The other factor that has fueled concerns about the credit cycle was the plunge in corporate bond issuance in December. Here as well, we think the decline in issuance and the widening of spreads was related to the tightening in financial conditions at the end of 2018. So actually, we think that overall credit conditions are tightening only moderately and remain supportive of further economic expansion. This tightening in credit condition is another reason for the Fed to stay on hold through at least the first half of this year. However, the duration of the pause will probably depend on the inflation outlook. How do we see inflation evolving this year?
Well, we have an inflation forecast, an inflation outlook that is fairly moderate. We don't see any significant upward pressure on the inflation front in 2019. We think headline inflation will actually fall before it rises because of lower energy prices. And the core inflationary pressures we don't see much upside to. We've looked at a decomposition both bottom up and top down. We looked at Phillips curves. We looked at cyclical versus acyclical views of the inflation outlook, and none really seem to indicate any significant risk of inflation running away at this stage. So we think core will remain fairly anchored around 2%, and therefore we don't necessarily foresee the Fed to come off of its very patient approach that it's adopted over the past few weeks and is likely to do so. What's our view, Lydia, in terms of the Fed outlook in 2019?
So as you mentioned, the financial market turbulence at the end of 2018 have led to a significant tightening of financial condition. And this, along with the weaker global backdrop, have pushed the Fed to make that extreme dovish policy U-turn that we have seen at the January FOMC meeting. We have seen recent comments by Fed officials which show that both hawks and doves on the FOMC seem to be in favor of that long pause. And it is clear that with that combination of weak activity data and subdued inflation figures that we have seen in recent weeks, there is somewhat of a stronger case for a long Fed pause. But for now, we continue to expect the Fed to stay on hold through at least the first half of the year and see only one rate hike this year, likely in the third quarter. An interesting thing to note as well is the fact that this dovish shift will likely buffer growth in 2020. We estimate that the cumulative Fed tightening over the last couple of years represented a monetary policy drag of 1.25 percentage point on real GDP growth last year. And we think the drag this year will be at least as large. But if the Fed follows market expectations and remain on hold for the whole year, that could translate into a significant GDP growth buffer of about 0.3 percentage point in 2020. Another important Fed development is the fact that policymakers appear to be seeking greater flexibility in the conduct of monetary policy, and they are going through a rethinking of their monetary policy and inflation framework. Can you tell us a little bit more about this?
Yeah, the Fed is indeed going into an 18 months review of its strategy, tools, and communication approach to monetary policy. And we think that will bring about a few interesting developments. One of them, in terms of the strategy, will be to consider a different type of approach to controlling inflation, which is it's one of its mandates. There are discussions about price level targeting, average inflation targeting, which are makeup models. Essentially, past misses on the inflation target still matter, which is very different from today's 2% inflation target. There's questions about how large the Fed's balance sheet will be once it starts normalizing, once it ends its normalization process. It's increasingly likely that the Fed will actually stop the balance sheet normalization sometime this year, actually, whereas in the past there were estimates that the balance sheet would end or be normalized later in 2020 or even 2021. There seems to be a desire to have ample bank reserves on the liability side, and that would lead to a somewhat larger balance sheet after the normalization ends, and a balance sheet that could be as large as $3.2, $3.4 trillion. So a lot of rethinking is happening at the Fed. One of the reasons why there is that rethinking is because there are fears that we could hit the zero lower bound again in the next downturn. And one of the cross currents that the Fed has been paying close attention to is the fact that we've seen this generalized global slowdown. Are you worried about this global slowdown really pushing the U.S. into a recession?
So you're right, Greg. The deceleration in global growth is becoming more and more synchronized, and growth in many countries around the world is surprising on the downside. This weaker backdrop has implications for the U.S. economy, although we do not think that the current global slowdown has the capacity to put the economy into a recession. But we will be monitoring several channels for signs of contagion. That includes financial markets and their impact on economic confidence, trade linkages. On the trade front, we're particularly exposed to slower growth in emerging markets and Europe, and the commodity price channel as well. It's important to keep in mind, though, that the U.S. is still relatively closed and mostly domestically driven. So as long as the slowdown in consumer spending and business investment this year remains gradual, as we expect, the U.S. economy should prove resilient to the global soft patch. One element of this global slowdown is the U.S.-China trade war. The ongoing negotiation round seems to be going well, and we have received encouraging news last week from President Trump. But is it too early to declare the end of the trade war, Greg?
Yeah, I think it's too early to pop the champagne, but it is encouraging to see that both the U.S. and China are coming to terms on some form of a deal. Now, we know the president likes to have these trade deals, and we know that he also understands that he needs to keep the pressure on China if he wants to get some form of deal. I think the deal that's likely to happen in the coming weeks is more likely to be a deal of promises. China promising to import more goods from the U.S. Promises have been, or rumors have been heard of as much as an additional 1 trillion of imports from China over the next few years. We know that can be quite difficult, that being said. There are also promises of keeping the currency stable, but again, this is a promise. Or would be a promises to address intellectual property protection rights. And that is also something that China is working towards. But we also note the fact that there are still underlying tensions, very different strategic objectives, very different ideological beliefs, questions about how to verify and enforce these types of agreements and this deal. So I don't think that we're going to see a major de-escalation of trade tensions, but rather, for the time being, a moderation of the tensions that we're seeing. So it is encouraging, but let's not be overly optimistic in terms of the outlook. I think there are still risks on the trade horizon. So with that, thank you very much, Lydia, for this podcast, and we'll speak again in March. Thank you.
Thank you, Gray.